Okay, everyone, welcome back. Day 3, Master Trader Program, Super Performance Workshop. I'm here. David Ryan's back, and we're going to get
Yep.
started. Welcome, Dave.
Yes. Glad to be here again.
Let's start off just by recapping a bit here and talk about what we went over in the last couple of days. So first, we went over categories and catalysts. We talked about the various ways that we categorize companies, and the reason is because we want to know what the company does, what industry they're in, and what type of company it is. Because if it's a turnaround situation, we have to apply our earnings metrics a little bit different than it's a straight growth stock. If it's a biotech stock or some stock on a drug that there is in the pipeline, they probably don't have any earnings. Good chance that they don't have any earnings. 75-80% of biotechs don't have earnings. So now we're trading it off the technicals, and we're trading off of FDA approval process. And then cyclicals have an inverse relationship, an inverse PE relationship. Big institutional stocks, I like to buy those low in the base before they're obvious off of bear markets. You get some opportunities off of bear markets to buy some of what they call stalwarts or slow growers. So you really want to know what category the company's in and what they do, and know a little bit about that company so you can figure out exactly how you're going to approach it. Then we talked about valuation, where basically, we don't really, valuation is not something that David and I really get too concerned about. When if it's a real low PE, if the PE was like 4, then we might be thinking, okay, that's very abnormal. But a super high PE is okay if the growth is there. And sometimes even with the biotech, it's trading on the prospects of a blockbuster drug. So we smashed some common I guess some common things that are thought about valuation and some myths, if you will. The trend, we talked about the trend and how, of course, you want to be in a stage 2 uptrend, and that's really the only stage that we want to be in. We want to make sure that the stock is in that stage 2 uptrend before we even look at the stock. And you can do that if you're using MarketSmith. You can use the my trend templates that are in MarketSmith. Fundamentals, we went over the fundamentals, talked about earnings, sales, and margins, and sliced and diced them in a whole bunch of different ways for you to be able to apply them to the various types of categories. And then we went a lot on price and volume, which we're going to do more of, and entry points, and really started fine tuning and coming down to a very, very specific days that we're looking at, and volume days, and looking at confirmations and violations. So now we're going to talk about one of the, and this is sort of I don't want to say, I guess it's a 2-part. We talk about 2 of the areas or setups that we really favor for big moves in stocks. And one is what we call a magnitude play, and the other one is what we call a velocity play. Now, today, or right now during this session, we're going to talk about the magnitude play. The magnitude play is the primary base, which is usually the first viable base after an IPO, or sometimes it's the second base. It's very, very close to the beginning life of a stock after it goes IPO, which we call the primary base. The reason why we call it a magnitude play is because this is where, if it's going to become the next Starbucks or the next Amazon, this is about as early as you can get, other than getting it on the IPO. So there's a huge move that's potentially on the table. Now, a velocity play, which we're going to talk about in the next session, is what we call a power play, and these are setups that can move very fast, and they can make a large gain in a very short period of time, and that we're going to get into later. So we're going to focus on the primary base, which is the first viable base. Now, I don't know, Dave, is there anything that you want to just open it up here before I get into some charts? Anything you want to say about the primary base? And
Well, I'd just like to add that a lot of the greatest winners were IPOs, and maybe not all of them were brand new IPOs, but a lot of them were IPOs within the last couple of years, and maybe even back 3 years, but a lot of them were IPOs. These are ones that institutions, if they see a great story and great earnings, they're going to have to get aboard. And so that's what causes some of those great moves. after an IPO has gone public.
Yeah, and during live trading, when we're screening with MarketSmith, we'll show you some screens, and I have one in particular that's specifically for IPOs. It's a really great way to look for the IPOs and to scan them. As Dave was saying, when we look back and we look at the biggest winning stocks and the fastest moving stocks, 80% of them were IPOs within the last 8 or 10 years. So they're relatively new. Even a 10-year-old company or that's been public for 10 years is really not that old. When you look at Coca-Cola, that's been around since, I don't know, the 20s or 30s. GE, these big companies, or even an Amazon's been around for decades. So just 3, 4, 5 years, or even 8 or 10 years is relatively new. So let's show you some examples. So Yahoo, which another thing to point out here is that some of these stocks you're going to look at and you're going to say, oh yeah, I know Yahoo, I know these names. But at the time when this was an IPO and just coming out of this base, very few people knew who Yahoo was. This is 1997, and this is where I was buying it. I was buying it right here, and I was trying to get. This is when I had institutional clients. I used to advise some of the big hedge funds, the traders over at George Soros Management were my customers. A lot of the real big hedge fund guys were my consultant clients, and I went around pitching the Yahoo and some of these other internet stocks because I thought the internet was this next big big theme, and they were all setting up and breaking out. And at the time, we talked about this, during the valuation section. The PE in Yahoo was 908 times earnings on this day that it was coming out, and I was buying it. Nobody wanted to touch it. They did not want to go near this stock. And this stock went up almost 8,000% in just about 2 years. So again, this is really, and you'll notice here, you see how it breaks out of the base and then just comes in for a couple of days, but then boom, you get the tennis ball action. See that right back, even though it didn't follow through, it came roaring back and the volume came up. Now, look at this is a big VCP, and you really see you get tightened right here. You come down 1, 2, 3. You can call this a 1, 2, 3, 4, but perfect VCP. I mean, this is as good as it gets. And you'll see stocks set up like this all the time. Right in the modern right to this day, you'll see stocks set up like this all the time. Take a look at Amazon. So again, now here, when Amazon's breaking out, this also is in 97. Right around the same time, we're looking at July 11th of 97. And a little bit after that, we're looking at September 5th, 97. Amazon starts coming out. Perfect little base here. You see, again, correction, similar to something like a Facebook or a LinkedIn, where, it went IPO and had a big correction first and then tightened up. And now right here, this is where it's ready, starts coming out. I was buying it right here. This is another stock that nobody wanted to touch. The word on the street, or the research that was on Amazon at the time, on Wall Street, the common, I guess, opinion of Amazon was that they would never make any money. I don't remember if I said this before, but the thought about the internet back in 97 was that nobody would ever make money in retail online. Nobody would make money. And the only thing that would make money was pornography. At the time, that was sort of what, was broke as the first sort of retail business online was porn. And the funny thing is now decades later, the porn is free and everybody's making money online in retail. So it was completely 100% wrong as far as what the research was saying. And again, the stocks were breaking out. The stocks had that intelligence. And this stock just in 16 months went up 2,500%, and then almost 80,000% in the next 2 decades. So again, right here, if you bought it here, it would have never come down to your purchase price again. And let's say you just, you bought this stock, and even if you swing traded it and it went up 20% and you sold 90% of it and you tucked 10% away, I got news for you. Regardless of what that number was, it'd be worth a heck of a lot of money right now. Let's take a look here, a couple more. So Starbucks. And, again, these are names that right? These are household names, but they were not household names at this time. And you can see how they're all setting up with this VCP. And giving you that perfect entry point. We can go back. We can look at 1920s, the 1930s, the 50s, the 70s, the 80s, the 90s. Same thing. Same thing happens over and over and over and over. So, Dave, the question that I always get is, if this happens over and over and over, and it's so, repeatable, why isn't everybody doing this and making a fortune?
Well, first they have to change their mindset, because a lot of people are convinced that you buy low and you sell high, and you don't buy new highs. So that's one thing, and then you know it requires work, and it requires doing things that most people don't want to do, is spend time researching these stocks and looking for these bases and training yourself to get your eyes and your mind set on what is a successful stock. So it takes a lot of work, and I think a lot of people, they want to take the shortcut and have someone feed them ideas, but boy, there are some great opportunities out there, and they're going to keep on coming as long as as long as they don't fool around with the tax system so much that they take away the incentive to start these great companies.
Right, and a couple of things. First of all, it takes skill. All right, it takes a skill that takes years to develop. And not too many people are willing to get that skill or to develop that skill and stick with it. There's periods that go by where this doesn't work very well, and you've got to stick with it. And so it's not easy. It's not like it's this easy thing to do. It does take a lot of work, as Dave said. But here's the thing. Here's what I like to say to people. So why isn't everybody thin and in shape? I mean, we all know you just diet and you exercise, right? I mean, considering if you have a medical condition, maybe, but for the most part, for most people, if they diet and exercise, we know what to do. All right. So why isn't everybody in shape and fit? It takes discipline. It takes discipline, commitment. So just because the answer is there, just because the path is there, doesn't mean everybody's going to walk that path or be able to stay on it. So again, let's take a look here. Dick's Sporting Goods. This is another stock I was buying right here. And it's similar to some of these other names like the Amazon and also Yahoo, where you get this big cup, if you will, and then you come up the right side, and then you really start tightening, and you go through those tightings, and you get a nice VCP action. Notice how every single trade that I'm showing you has VCP characteristics. Everyone. We're not going to show you, I don't think, one single stock through this entire, unless it's in the selling section. For buying, we're not going to show you one single stock that doesn't have VCP characteristics. And 99.9% of every stock that I ever buy has VCP characteristics. So it's real important that you understand whether it's an IPO, no matter what it is. So some people say, well, why don't you buy it? Why don't you buy on the IPO? If it's such a great company, maybe buy it right after the IPO. Dave, why are we not going to buy, pre-IPO or even, maybe one day or a couple of days after it trades? Why do you avoid, the IPOs right off the hop?
Well, because sometimes they're very, very hyped, and they come out at really ridiculous valuations, and then they have to come down and reset. So you don't know exactly, how they're being priced. The best IPOs are usually the ones that come out in a very difficult market, and there's not much hype to them, and there's not that much interest in the market because you're probably going through a bear market. Those are some of the best, but you have to be careful in some of the very, very strong markets and that have been going on for a while, because the investment bankers are looking for anything they can get their hands on to go public. So I like to see them. I like to see them seasoned. I like to see them out there and trading for at least 4 weeks, a couple of months, so they can set up proper bases to go from.
I like that. I like that seasoned. So again, Dick's, just to talk about, to highlight what Dave was just saying. Okay, we're in April of 2003. This was, brutal bear market. In April of '03, there not too many people were thinking about buying stocks. I can tell you that after that bear market that just lasted for years, and this is coming out of a really tough market. This is where what Dave was just talking about, how a stock setup coming off of a bear market or a tough environment. Take a look here. You can see this is Dick. Now we're not seeing the price action prior to this where we saw that big bear market, but you can see the market is just coming off the lows here, and Dix is setting up quite nicely in a classic VCP, gets the shakeout, and you can see the relative strength line. See, is moving into new high ground. Even as the market is going lower, the stock is holding up, and because of that, it's getting a nice relative strength where it's picking up there. So that's one of the things that had me looking at that stock, is it was holding up quite nicely in a tough market, and that RS line was hitting a new high. Here's another one, looks a little similar. You see a lot of these look very similar, but it's like a fingerprint. You look at it from far away, they all look the same. You look real close, they've got these little nuances, but they all have VCP characteristics. That tightness on the right side and going through that ringing of the towel is so paramount that you stick to that, and you make sure that your discipline is that you only buy stocks that have these characteristics. So this comes out of this perfect little base here. Actually, it's a pretty good sized base. Tightens up on the right side right there with that last little tightening between 29 change and 28. Very tight. Goes up 450% in just 28 months. Now take a look here. Look at the weekly. So these are going to look good on a weekly too. You don't want to start time fishing or trying to find the best chart or backing into, okay, it looks good on this time frame, but it doesn't look good on this time frame. It should look good on all the time frames, particularly a weekly and a daily. So I don't even think O'Neill ever really looked at daily charts very much, right, Dave?
Yeah. No, he almost exclusively looked at weeklies. I had to show him dailies to show him how they were setting up, because the one thing good about weeklies is that it eliminates a bunch of noise. And because sometimes the stock will look like it's breaking down in the first few days of the week, only to come back by the end of the week. And so sometimes it pays to look at the bigger picture and concentrate on that than getting faked out on sometimes the shorter term time frames.
Yeah. I always consult the weekly as well as the daily. So here's Borland again. You can see very tight here. I mean, look at this. There's almost no fluctuation whatsoever for 1, 2, 3, or 4 days. Then it comes out here, you get the follow through, and then you get another little pivot right here. So you get you can call this a low cheat right here or cheat right here, and then you get the handle that forms, it drifts down. Really just classic textbook, 530%, 22 months. Another one here. This is one that I traded, Farmion, 270% in 6 months. Again, if you just get a piece of one of these moves, now let's just say you don't get that whole move, you get a quarter of that move. If you got 10% of the move, it's 27% in 6 months. That's 60-70% a year just in those two trades. ROI. L3 Communications. I actually bought this a couple of times, but this was my first buy. Almost 300% in 43 months. This was Voya. Now, this didn't make a huge move, but a pretty nice little 71% move. The pattern is perfect, though. Perfect little cup with handle here. A nice little tight pivot comes out. A few days, tennis ball action. Shake Shack, again, coming out right here. Quick move up, 86% in 30 days. See, that's what I really like. I like these stocks that go up 30, 40, 50% in a month or two, because I can really roll that over on a swing basis. Let's see, what else? This is Shake Shack a little bit later. So you got one setup off the IPO right here, and then you got another setup that subsequent to that, and another trading opportunity where it went up 60% in 40 days. This is similar to how I traded Yahoo. It made that big 8,000% move. But I was buying, I'd buy it breaking out of a base. It would run up. I think the first time I actually took a double. One of the times I was up 100%. And then a couple other times I was up 40 or 50 or 60. And then there was one time I was up 30. And you compound all those moves. It's a really big number. So here's Alibaba. Again, look at this big base. See, VCP forming right there. You see how all the action starts after you complete the VCP. And when you come out, that's where all the action is happening. And in that stage 2 uptrend, that's where the excitement is. That's where you're getting the inertia. 94% in 10 months. And of course, Dave, you know this stock well. Ollie's Bargain. I think we talked about it earlier. I was buying it right here. Actually, I bought some, I think it was right here too, as it turned up right here. And then I added to it here. And Dave and I were actually, without unbeknownst to each other, we were buying it on the exact same day. And so we were buying it right here. Dave held it for a much bigger move than I did, but this went up 330% in 30 months. As a matter of fact, Dave came down to Myrtle Beach for the seminar for the Master Trader program that we were doing. And prior to it, the day or two before, he went to go see an Ollie's Bargain because we had one in Myrtle Beach. Here's the weekly. Look at what a beautiful weekly. I mean, it's just absolutely picture perfect. It couldn't get any better. Just perfect, comes out of here just right. We talked about this before, where look at the PE ratio. Okay, so when this is coming out of this base here, that and even off the initial IPO and around the lows, we're up around, I don't know, 140 times earnings. And when it's coming out of this base, we're at somewhere around 100 times earnings. Now the stock makes this big move, right? Makes this big move. And look, after it makes a giant move, the PE is cut in half. So that's because the stock's earnings, the company's earnings, were growing at twice the rate that the stock was going. This is why a stock can keep going, because as the stock's going higher, you think it's getting more and more overvalued. No, not necessarily. It could be getting undervalued. If the earnings are growing fast enough, the stock could double, triple, quadruple, go up tenfold, and it's a better value than it was 5 times lower, depending on the earnings. That's why having those big earnings is so important. Body Central. This was one that I was around. You can see it's actually December is right here. It was around Christmas time, and I was in a mall with my wife, and I saw a Body Central, and I liked the merchandise, the way it was really colorful. It just seemed it attracted me so much to go in. And I don't know, when it comes to women's clothing, my wife is the expert there, but she thought it was really a great place, and she said, yeah, this is probably it's more youthful for a kid, but she says this is definitely, they got it together here. So right away I went and I looked to see if there was, if it was public, and sure enough, it was setting up in a base. And I bought it as soon as it broke out, and I sold it right into this move right here. But it was a nice little quick rip. Michaels was another one. I was buying it here. New IPO. This was Phillips. This is one actually that I was watching and went up over 100% in 6 months. I was watching this and had it on my list, and I did not buy it because I very often stay away from oil stocks. And this is one of the times where I stayed away from it, and the stock was right and I was wrong, as usual. But it came out of a perfect little pivot here. And look, 1, 2, 3, 4 to 5 days up. Really, this is probably up but just a little bit, but really, really nice breakout action. Now, important thing to look at here, if you look at this Phillips 66, this is a weekly, and this is just going through the stage analysis. You come out here of your IPO, you go into stage 2, you make that big move. It goes from, I don't know, $30-$35 up to $75, $80. So, it's a good 100 and something percent. Now you go into that stage 3. See, it gets real volatile. Some people would look at this and think this is a cup with handle. Well, it does map out a cup with handle, and it does map out VCP characteristics, but it's too wide. It's very wide. It's loose. It's all over the place. And then, of course, even if you bought it here trying to come out, didn't really even come out. It broke down. And now right here, now you're going into stage 4. So you should be long gone. So you can even see this maturation cycle sometimes in a relatively short time frame, where it doesn't have to take, years and years and years or decades. It can happen, the whole, 4 stages can happen in just a couple of years. LinkedIn. So this is one that, like we talked about earlier, and Dave was saying how sometimes they go IPO and they're all hyped up, and they just fail right off the hop. And this is the same thing that happened with Facebook. Yep. But you see, and I waited till way over here. I wasn't buying this stock. Now, here's really something interesting. Notice how I'm not buying the stock until it's at just about an all-time high. And you see, that's where the action happens. That's where this really, everything starts really, taking off here. As a matter of fact, it broke out here. And then I was on CNBC. They asked me for one stock. They said, can you give us just one stock? And I thought about it. I said, okay, it just broken out and had this big move up. It was extended, but it was such a strong breakout that I knew institutions were really piling into it. LinkedIn was my one pick. I was on actually with Tyler Matheson. I think it was in 2013. And this stock went on to make a nice move there. Let's see, a few others. Pega, I bought this twice, once here and once here for trades. Here's a weekly of Shopify. You can see, the IPO again rolled over, and then see once it tightens up, that's where it's breaking out here. Just showing you a few of these examples.
Yeah, and Mark, one thing I've been doing while you've been going through these is that on my MarketSmith program, I've actually been going back, and on some of these that are still trading, you can go back and you can go to the day when these broke out and then actually really study in detail the breakout and the move subsequently going forward. And that's where you can really learn a lot when you take these examples and then, put them up on MarketSmith and start studying them.
That's a great tool on MarketSmith where you can backdate the chart and then you can move forward day by day by day. And actually, as Dave said, you could live through it as if you were there trading it. So we're giving you hundreds of examples here. And these are great examples of real life situations that were actually traded at the time. So yeah, absolutely. Dave, as far as again here, this is a good. Looks like your porcupine. It's got a bunch of Dave has a tendency to come up with metaphors that they stick for whatever reason. You come up with stuff that always sticks with me. I don't forget it. It's very visual.
Well, it looks like, every time it gets that same level, it spikes up and it comes back down, and then and it happens over and over again. When it finally gets through that, look what happens. It gets going.
And that is exactly my point of this chart, is that I want to show you that what we're looking for, this really illustrates what we're looking for here. So we want to see some demand off the lows. You see here, you have some good demand right here. And then it goes through the VCP and it tightens. And what I was pointing out earlier, when Dave says to, draw a line across the highs there from the pivot and see where the majority of the action is. And you can see right here, all this price action is happening where it's stalling out at around the same level. So what your job is to find the spot at which this supply stops coming to market, or at least it appears that it stops coming to market. We don't know for sure, but we can make a pretty good educated guess by looking at how the stock's trading on the right side. And if it quiets down and it gets tight and the volume comes down, we don't have the volume here, but if the volume comes in, that is that's the footprints of supply coming down and less supply coming to market. Now, once you come out of there and you clear that level, you've cleared that troublesome level, and that also gives you some assurance that supply has stopped coming to market, and now there's no more supply. It's getting through there. This is just simple supply demand dynamics. So if if there's only X amount of shares in the float, and there's more demand, and then you're going to have the stock's going to go up. If there's so many shares for sale but there's a lot more demand, if there's so much demand but there's more shares for sale, the stock's going to go down. It's no different. If we were to auction off, let's say, iPhones, or iPads, and I had a trunk full of them, and there was 100 of them in my trunk, and I said, hey, I got iPads for whatever, $1,000 a piece, or maybe I start off even lower because I have so many, and now people start buying those, and as the supply gets lower, they become more valuable. And the price, I could start raising the price. It very, very simple. And if you were to go and chart, if you were to go to an auction and look at the bidding and on anything, I'm talking like a car auction, anything, look at the bidding. we actually did this. There was a study that I did with a group. This was a long time ago, decades ago, where we studied auctions and certain types of anything that was an auction marketplace and charted the pricing. And we found that even auctions, the pricing was forming patterns, and it would have supply and demand. It would form VCPs. You'd have tight areas, and it would break out. It was really quite amazing. So. This is just universal, universal. And the reason why I have to keep pounding this home with you is because at some point, you're going to have well, you might be right off the hop because you don't know what you're doing in the beginning. You're going to definitely have difficulty. I assure you that this is not going to be easy. And if it is, God help you, because then you're going to get sloppy and think it's too easy and probably have some real problems. But you're definitely going to run into trouble, and it's going to take a while to get this down. So you've got to have a really strong conviction in the strategy and in the reasoning behind it, the research behind it. That's, I guess, probably one of my secrets, I guess. And I'd say, Dave, working with O'Neill, and seeing his success and the organization and what he built from that, that probably had to, give you some confidence. If you didn't have the confidence in it yourself, you certainly saw the work that was done in the research. I don't know about you, but I was really a believer. Once I saw what this was all based on, with supply and demand and earnings and sales and how it really worked, and went back and saw that nothing changed for 100 years, I was sold. And then I took personal responsibility. If I didn't do good, I didn't say, oh, the strategy doesn't work. I just said, okay, well, I just got to get better at it. And that's what made me stick with it. How about you?
Yeah, well, I think you become a believer when you actually see it work in your own account. I mean, right. When it's like, if you haven't had a strategy, you haven't had a discipline, and you're just kind of here and there, and you're listening to tips and rumors, and then all of a sudden you get these set of rules and you enact them, and then they actually start working, and you see these stocks take off and go, you just go, oh my gosh, I've never experienced this. It's acting like it should. And you're sold on it. Because once you see that success and you can see the gains that you can accomplish, you never want to go back, because you can see that it can be so rewarding.
Yeah, and the timing nature of it, I think it feels to me like anybody who's ever played golf knows how great it feels to hit that ball nice and square and just hit a really great shot off the tee, and really get all of it. It just feels so wonderful. And that I get that same feeling when I buy a stock and it just bang, it takes off and blasts off to the moon. And I got that timing just right. It's like hitting the golf club right on the screws, even though they don't have screws anymore. But,
but
that's dating me. That's dating myself on top of
it. Someone can tell you about this and how it works and the whole thing, but it's when you do it yourself and you can feel that success and you can see your account gaining very, very quickly when you hit something exactly right. That's when it'll be very hard to shake that, and you're just going to want to do it more and more.
Yeah. And when I saw, the compounding effect, that how quickly I can time a stock and even get a 20% gain or 25% gain in a matter of days or months, I did the math. I said, wait a minute, if I get, 8 of these in 1 year, I put this amount of money into each of them. Holy cow, wait a minute, is that right? 250%. The numbers were just amazing. Okay, let's just say I do half of that, 125%, half of that, 70%, 75%. Holy cow, this is really something else, almost like it's too good to be true. Well, it's not too good to be true. It's going to be very difficult, and it's going to take a lot of work, but we're giving you a big head start here. So I'm going to wrap up. Also, I just want to back up for just a second, because Dave was talking about where I asked why we don't want to buy on the initial IPO. In this section, we started off with talking about this as a primary base, of course. So I want to sort of circle back and just also tell you that another reason that we don't want to buy on the IPO is that there's no price action. So if you're trying to do technical analysis, there is no technical analysis that can be done on one price bar. So if you want to look for the VCP, I mean, you could use intraday charts. That's one way. But again, I default to the daily charts. Right here, you can see on Burlington, you actually had a little VCP right here, and you broke out. You made a little bit of a move, but then it came in and it's all over the place. And now you got to wait for that base to form. So sometimes, you'll have an IPO base. It'll set up. It'll break out. And you'll get knocked out, and then it'll reset, and you'll get another base. You might get, over a course of a bull market or a secular move in a stock, you might get 5, 6, 7 bases. You'll definitely get a lot of opportunities. But this is the earliest. This is when we're trying to get on board, the earliest that we can, subsequent to the initial IPO, primary base. Okay, so we're going to wrap this up, and we'll be back. And then we'll talk about the velocity play, and that's also going to be exciting. All right, bye bye.